Thanks, John. Well, it's a pleasure and an honor to introduce Allan Meltzer. I think all of you know that Allan's a very famous guy, that he's published over 300 papers, a number of books, and he's currently working on a book that he's going to talk about today, The History of the Federal Reserve. Now, Allan's had a tremendous impact on public policy over the years. He's a very well-known monetary economist, and in the 1970s started the Shadow Open Market Committee, which would review and evaluate Federal Reserve policy. And over the years, I think Allan was co-director or head of that until the late 90s. And over the years, policymakers were very interested and paid a lot of attention to the Shadow Open Market Committee. More recently, he's also served as chairman of the International Financial Institution Advisory Commission. It's a bipartisan commission appointed by Congress, but it's better known as the Meltzer Commission. And they've had a tremendous impact on the World Bank in creating incentives to use money in a way that has more impact than it has in the past. And I could go on about a number of things, but what I'd like to talk about that I'll never forget is February 26, 2003, when Allan received the Irving Kristol Award. This was the first Irving Kristol Award. It replaced what was previously called the Francis Boyer Award. And recipients of the award included Gerald Ford, Paul Volcker, Ronald Reagan, Alan Greenspan, Henry Kissinger, and, of course, Allan Meltzer. And at the event in Washington, D.C., there had to be at least 2,000 people, all in black ties. We had to go through security to get in because the warm-up speaker was President Bush. And then Allan gave the main address. But it was a wonderful event and tells you the kind of stature that Allan has. And he's just recognized worldwide for his contributions to economics and public policy. So I look forward to hearing about the history of the Federal Reserve. Allan, thank you.
Thank you very much. If it had been breakfast, I wouldn't be here. I don't get up that early. For the last 15 years, pretty much regularly, but off and on, I've been working on the history of the Federal Reserve. I have access to all their papers, and there are lots of those, and the presidential libraries and so on. So I'm going to talk a little bit about Alan Greenspan, who's retiring this coming week as the chairman of the Federal Reserve. There have been 6 post-reorganization chairmen, and he is certainly one of the most outstanding of those. And I want to talk a little bit about what it is that he did that is of lasting benefit to all of us. I think that's a subject which we really belong to. Let me just say at the outset that I'm going to tell you some of his predecessors, and you'll recognize that most of you have never heard of them. There was Mariner Eccles, Tom McCabe, Bill Martin, Arthur Burns, Paul Volcker. Of course, Paul Volcker is well known, and then Alan Greenspan. Alan Greenspan has been there for 18 and a half years, the second longest chairman in the in the history of the Federal Reserve, which is now, which was started in 1914. What's interesting about writing the second volume of this history is how much you have to look into the presidential libraries and so on. In volume 1, we really didn't pay much attention to the presidential libraries. In volume 2, politics has become so much more important in the life of the Fed that we spend a lot of time looking at the papers of the presidents and of their advisors and of the relationships between the Federal Reserve and the administration. As we go to a new chairman, it is useful to think about what are the skills that are required to do that job. It's a very tough job, not because the analytics are so hard, although it's interesting to recognize that the Federal Reserve is almost 100 years old, and most of its history is not very glorious. It produced the Great Depression, produced the Great Inflation. It took it from 1914 to certainly somewhere into the 1980s to figure out how to do its job really well. And by doing its job really well, that means that we have had two of the longest expansions in peacetime U.S. history during that period, in the last 25 or 26 years, punctuated by two relatively mild recessions. That's the best record that they've managed to compile in any 25-year period or in any period at all. And so it took a long time to learn how to do, for them to learn how to do what it was that they were supposed to be doing. What they're supposed to be doing is maintaining stable growth and low inflation. Well, the job has really three aspects. There's a reasonable understanding of monetary economics. One of the ways that shows up is that originally central banks were run by non-economists. Practically all good central banks now are run by economists. The technical part of the job has been recognized, and it's not an accident that Volcker, Greenspan, Bernanke, Arthur Burns were all economists, that the Bank of England is run by an economist, that the European Central Bank is run by an economist who will also retire this year, Otmar Issing, who has done a splendid job of maintaining a low inflation rate under very trying circumstances in Europe. Well, so one part of the job is to have some understanding of monetary economics, and that's a necessary but not a sufficient training for the job. The second is to do the politics, and the politics are intense. I mean, I mentioned the role of the White House and the administration in this time. It isn't so much the president as the people who serve the president that create the problem. They're almost always more assertive about the president's role than the president. But there are the politics. But it's not just the White House. There's the Congress. And as we know from daily newspaper headlines, the Congress is not a unique monolithic body, but a very fractured body with lots of people who have different ideas about what is right or what they want to see done. But in addition to that group, there are the foreigners, the market people, the general public, the academics who criticize the Federal Reserve, and so you have lots of constituencies, and keeping them satisfied, at least sufficiently satisfied, so that you maintain the kind of aura that the Fed now has. That's an important second part of the job. And the third part of the job is that, would that it were not true, but it is true, that monetary economics takes you quite a long way to decide what the Federal Reserve should do, but it doesn't always take you all the way, and there's a period there where you have to take to evaluate the risks of doing too much or not doing enough, and that's a judgment call. We didn't know 18 and a half years ago that Alan Greenspan was going to be very good at making those judgment calls. We don't know whether Ben Bernanke will be good at making those judgment calls. We have to wait and see. But that third part, that is making the judgments that all of you who are in industry are certainly familiar with, making the judgments when you don't have enough facts, when the future is cloudy, when life is uncertain, but you have to decide whether you want to be tighter or easier in your policy, whether you think that there's a greater risk now that you're going to have a weak economy or a greater risk now that you're going to have a more inflationary economy, and there are all kinds of voices telling you what you should do, what you shouldn't do. So making that judgment, making it correctly, is a job that the committee that makes these decisions has to make, but the chairman has a very special role in making those decisions, particularly if he is, as Alan Greenspan has been, a very respected chairman. So that's a way of introducing the kind of job that the chairman of the Federal Reserve has to do. Now, what makes Alan Greenspan special? What did he do that that people didn't do before? What did he do better than people who were there before did? I would say that certainly one of the most important things is to think about where we were in the 1960s and 1970s, how we got into the big inflation, made the wrong judgments most of the time that put us into the inflation. One of those was a belief, a very strong belief, not just here, but most of the world, that said, in a private free market economy, we just can't get to low inflation and full employment without wage guidelines, government interference in the wage setting process, that a private market economy would just get to inflation too fast before it got to full employment. The Federal Reserve or the central bank would have to clamp down on the inflation, and that would throw us into another period of slow growth. And so we needed to have guidelines or government interference, and that started with the Kennedy administration, but it continued through Republican and Democratic administrations. They just weren't willing to let the market alone, believe that governments believed here and elsewhere that they had to intervene in the price. You don't hear that anymore. That whole idea is gone, disappeared. No one says that. What we now hear from central bankers and others is that the way to get to low inflation and higher growth is to have low inflation. That's a very different story, and that's a story which comes out of the success of the 1980s and the 1990s in both ending inflation and maintaining a long period of prosperity and growth. During the approximately 18 years that Alan Greenspan has been chairman of the Federal Reserve, per capita output in the United States went up from approximately $25,000 per person to $37,000 per person. That's an enormous increase in standards of living. When people wonder about why people are building these enormous houses and buying expensive properties, the answer is they're richer. And they become richer because we've learned that the way to get people richer in the United States has always been not spurts of growth the way the Chinese have as they adopt the new technologies, but steadily driving ahead at the rate of 3 or 4% a year, and for a long period of years. And if we can lengthen that period of years by not having recessions and having short recessions when we do have them, then that's the road to strong growth and higher living standards. And that has certainly been the case in the last 25 years, and certainly in the last 18 years of Alan Greenspan's experience. So we seem to have pretty good evidence now, casual but nevertheless good, that seems to support the idea that that stable growth and low inflation brings prosperity. Now, of course, it brings prosperity best in a period where we have high productivity growth, and as in the United States. But high productivity growth is not entirely independent of the kind of environment in which people live. Instead of thinking about how to make some extra money by managing your inventories during a period of inflation, business people now think about how can they increase their output, lower their costs, improve their productivity, and those are the questions that they ought to be asking and that we want them to ask and that they do ask, and that it does help in a period when there are innovations around to be introduced, as there have been in the last 10 or more years. So the first, and in my view, one of the most important contributions that the Federal Reserve in the Greenspan era has made has been to provide this environment in which private people looking to see how they can improve their productivity, their output, and their wealth, how those decisions have been facilitated. A second, back in the 1960s, and I was asked by Congressman Patman, who was then the chairman of the Banking Committee, to do a study of the Federal Reserve, or turned out to be a study of the Federal Reserve. And one of the things that we believed that we had discovered at that time was that their policy was pro-cyclical. That is, when recession was the problem, they were making it worse. And when inflation became the problem, they were making that worse too. And the reason that they did that was because they looked at what happened to interest rates, and they said, well, when the interest rate goes down, that's a sign that our policy is easier. When the interest rate goes up, that's a sign that our policy is tighter. They totally neglected the distinction between real and nominal interest rates, which I think everybody in the financial markets now takes more seriously, but didn't then. But they also didn't look at other things that they might have looked at, like growth in the money stock, to decide what was happening. And what was happening was that interest rates were going down because the economy was weak, and interest rates were going up because the economy was strong. And instead of trying to moderate those changes, they in fact reinforced them. They made the recessions longer and deeper, and the inflation's certainly longer and deeper than was necessary. Beginning in 1994, and especially in the recession of 2001, the Federal Reserve pursued the most countercyclical policy they ever done. They really changed the way in which they do things. Interest rates went down to 1% and stayed there in 2001, 2002, and stayed there for a long time. And so what was in some ways a very deep and serious recession, as far as profits were concerned, as far as investment was concerned, was a very mild recession in terms of employment, which is the thing that Congress worries about the most and that the public worries about the most. The unemployment rate never got above 6.3%. So it was, in that measure, it was one of the mildest recessions of the post-war period. But for people who were managing investment or looking at profits, it was anything but a mild recession. So they managed to make that recession. Now, what was remarkable about that recession was we had one of the back-to-back strongest automobile sales years in ever. We had housing booming because of the low interest rates, because you could buy a car with practically with very low interest rates when you financed it. That was due to the kind of policy we had. So this countercyclical policy really worked, and one hopes that it will continue to work, that is, that they will continue to work it in subsequent periods. That was a second great contribution of the Federal Reserve, and it was a conscious contribution. I had lunch with one of the members of the Federal Reserve Board somewhere during that period, and he said, well, you finally got your way. And I said, what does that mean? He said, well, that means that we are really consciously trying to keep the interest rate low, to have a countercyclical policy, and we think we're going to be successful. And they were. So we're now working that out. Now, that had side effects, which certainly I and I think most other people did not recognize, that a lot of the spending we did was overseas. It certainly helped the Asian economies a great deal. The imports flooded in. We financed them by borrowing a lot, and we have that problem to wind down at some point. There are some people who have for years seen that as a crisis in the making, but like many crises in the making, it will depend much more on what we do than on some inevitability that people seem to talk about. So that was the second big and very important change which has occurred in this period, where they are learning, finally, after almost 100 years, learning how to do what it is that they're supposed to do. A third and quite important change for the better has been what is now called communications policy or transparency. The history of central banking is it was none of your business what they did. They did what they did, and it was up to you to figure it out for yourself if you could. If not, too bad. Gradually, that tradition in a democratic society, it's very hard to maintain that tradition in a democratic society. Gradually, that tradition began to break down under the hammering of the Congress especially, and of others outside saying it would be better. But But here, a real achievement for economic theory. Ed Prescott and Finn Kydland, who won the Nobel Prize. One of the things they won the Nobel Prize for was for working out what was called the problem of monetary rules, and leading to a tremendous outpouring of literature on the role of information and how information affected things. And the learning was to establish a rather obvious point, but it's important to convince people, I mean, that it was really established. And that was the point that said that just as the markets, financial assets, markets for other assets, depend upon what the Federal Reserve does, the Federal Reserve depends upon what the markets do. And if the markets misinterpret their policy, then we're going to have less successful outcomes than if the markets interpret it correctly. So it was to their interest to tell the markets what they were doing. And after many, many years of fussing with the issue, they finally agreed in 1994, in the Greenspan eras, they agreed that they were going to announce what the interest rate was. Now, imagine what a change this was. I mean, and how long it took, and you get some idea of the way bureaucracies operate. After all, when they made the change, they started to buy and sell at a different interest rate than they had done the day before. And everybody in the market watched that, and they knew that the change had occurred. So who was the secret being kept from? Well, people who didn't operate in the market. So it was to get over that gap, and they worried about how it would set off speculation and do all sorts of other things. Well, none of that happened, and they now have established, and I believe forever, the idea that it's their responsibility to say what it is that they do. Some of the European central banks have been doing that for a very long time. In any case, Greenspan managed, I think a little reluctantly, or at least hesitantly, to get that done. And that has been this transparency, because it not only did made this what is really essentially a modest change of announcing what they were going to do when they, just at the time that they made the decision, but it also opened up the question for them of what information can we give? What is it that we can tell the market that they would like to know? Well, of course, they would like to know what the future is going to be, but none of us are in a position to do that or to tell them that. And so there is a serious problem of, you want to inform the market about everything that you reliably know, but you don't want to tell them things that are going to turn out to be wrong, because then you're going to mislead them, and that's going to be costly. So they have really done a lot in the last 10 or 12 years to work out what they call their communications policy. What is it that they can reliably say about what they're going to do? For example, should they say, well, we've just raised the interest rate 1/4 point, but in the next move we're thinking about going another 1/4 point? Or is it better to just say, look, we're at 1% and we're going to head toward some number between 4.5% and 5.5%, and we're going to do that deliberately and 1/4 point at a time, and at every meeting. And while they don't quite say it with all that explicitness, the fact is that that's what everybody understood them to be doing. And lo and behold, the market responded by moving the prices of long-term bonds up to recognize that that was going to be that whole path, that it was going to go along that way. And then when they made these other moves of 1/4 point, nothing happened. Nothing happened. The market had already priced in the idea that we were going to go from 1 to 4.5 or 5.5%. Now we're back into the zone of uncertainty because we're up in that range, and they have to make some decisions about what they're going to do next. But we are really operating on a rule, gave the markets a lot of information that in the past they never would have had. So that's a third big achievement, and I would say, I would add to that, that Alan Greenspan, who has always been a strong believer in markets and free markets, especially from his very earliest days, that they have gone a long way toward deregulating aspects of the financial markets and making them much more open to competition than they were in the past. And with the help of of Alan Greenspan. The Congress, after having debated for years, literally years, where were the dividing lines between investment banking and commercial banking and insurance companies and so on, and everybody had his thumb, four fingers, and arm into that decision, they finally were able to pass legislation which opened up competition so that banks can do much more in the investment banking area, investment banks can do more in the banking area. There's just a lot more competition between them, and that's certainly to the benefit of business and consumers in the United States. And since the United States financial markets are so important, it's to the benefit of people all over the world. So that has been certainly another achievement. There's a long list of achievements. I'm not going to go through the whole thing. Early in his tenure, and it's an interesting experience, early in his tenure, 2 months after he became chairman, we had a really substantial rattle in the stock market with prices going down about 25% in a day. And he established himself as an effective Federal Reserve chairman by handling that crisis very well, and thereby won the confidence of the markets, Congress, and others that he really knew how to do the job. That's very important, and there'll be a testing of every Federal Reserve chairman, as perhaps not as extreme as that. I can remember that period because I was writing Fed history then, as I am now. The Wall Street Journal, I believe, the New York Times, used to carry on the financial page almost every day a picture comparing what had happened in 1929 to what had happened in 1987. And the obvious inference was we're headed for another depression. People like John Kenneth Galbraith and others, but especially Galbraith, had talked about the role of the stock market collapse and how the stock market collapse had precipitated what became the Great Depression. I think that's a wrong story and has very little foundation, but the 1987 experience certainly didn't bear that out. That is, we didn't even have a recession in 1988, never mind the beginnings of the Great Depression. What we had was a strong recovery, and suddenly those two lines, which they were drawing in the Wall Street Journal every day, showing what had happened to the 1929 market, what happened to the 1987-88 market, the two lines began to diverge, and for the better in the recent period, and they stopped publishing that silly chart. So that was an important and an interesting episode for him and for all of us, which came out very well. I'm going to finally say a few words about an issue which remains contentious and which is perhaps the major criticism of the Greenspan era, and that is he came to a dinner in 1986 and talked about irrational exuberance and how it was operating in the stock market, and then he didn't do anything about it. And people gradually, vociferously, eventually criticized the Federal Reserve for not doing something about asset markets, and why didn't they break this bubble? Well, let me tell you that while everyone talks about the bubble in the stock market, I'm perhaps in the minority that doesn't believe that there's much to that view. One of the things there are two things which the bubble people never really tell you, and one is that the best theory that we have, I suppose there are three, the best theory we have says that you can't identify a bubble until after it occurs, and not always then. So it's problematic whether you have a bubble, but it's certainly problematic to try to prick it if you don't know whether it really is there or not. Second, most of the theory about bubbles is developed, all of it is developed in a world in which the prices move without any transactions. But third, there were transactions, lots of them, and the people who say that there was irrational exuberance on the part of the buyers, what about on the sellers? What were they thinking? Did they think that prices were going to go down? Why did they sell their shares? All right. So we need an explanation if we're going to believe about the bubble, we need an explanation which tells us something about what the sellers were doing, the people who sold stock. Now, there are people who say, well, there are a lot of new issues in that period, but that barely scratches the surface of explaining who the sellers were during that period. And that's, I think, a big puzzlement if you believe that the bubble was the problem. My own view is a very different one. My own view was that there was a big productivity increase, particularly in the high-tech industries. There was no big surge in stocks of companies in more ordinary industries. The big surge was in the stocks of the high-tech companies. The belief at the time was that with the productivity gain, there would be a big increase in profits. It turned out that entry was very easy. In fact, too darned easy. And too many companies started up, and many of them went broke when the decline came. And that was the lesson which people learned. There was a productivity increase, but it wasn't going to be all that profitable for many of the people who entered. And when they finally, in mass, figured that out, there may have been some additional enthusiasm that was not generated by data. But the fact is that when they figured that out and it became clear that there wasn't going to be high profitability, many of those companies that had started up using the internet to sell dog food collapsed. So that's a different story. In any case, what should the Federal Reserve have done? I mean, the Federal Reserve's job, and it's important for all central banks to recognize that their primary responsibility is to keep inflation low and keep the economy growing at a reasonable rate, the best rate that it's able to achieve. If the asset price rises as a sign of inflation, my story is, of course, it was a sign of productivity growth. But if it's a sign of inflation, then the central bank should deal with the inflation. That is, not with the asset prices, but with the inflation. There was not much sign of inflation in the late 1990s. Even a person who was very conscious of inflation, like me, would not have acted to try to slow the inflation. If it's a real event, that is, if it really is because of productivity and profitability, then we should let it happen. It's not the Federal Reserve's job to prevent people from making stupid mistakes, and it's not their job to prevent the economy from growing faster. And that's a judgment they have to make as to whether it is growing faster or whether it is inflating. But there was no sign of inflation, and in fact there were many signs that this was a real event. And the third part of that is, what are they supposed to do? If it's a real event and they try to end it, they're going to cause a recession in the economy. Is that really what we want? I mean, if asset prices are going up at 25 or 30% a year in the stock market, how much do you have to raise the interest rate to stop that? More than would be useful from the standpoint of ordinary people who are running retail stores or manufacturing companies producing goods and services that people buy, more than they will be wanting to pay to borrow money to expand their businesses or hold their inventories or manage their accounts receivable, than because we're trying to head off these other things. Is that what people think should happen? I mean, the story about the error is I think, an incomplete story. And my view is that what the Federal Reserve did was right, in both the sense that they didn't try to manage asset prices, and second, that after the collapse came, they managed the recession quite well. That is, as I said before, they cleaned up after the problem and made sure that that we didn't have it. And that I think is a very good judgment call on the part of the people who had to make those judgments. So that's been a remarkable period, 18 and a half years in which we've seen just rapid growth, great improvements in productivity, increases in standards of living for the economy, and a very strong period. We leave behind some problems that are still there. that will be there for a while, and that the next chairman will have to wonder about. The communications policy is incomplete and is being studied, thought about. That will certainly change over the years as to what they communicate and how much they say. And of course, there are the long-term problems about the amount of borrowing that we do abroad and the management of the budget deficits. I mean, we've been very fortunate that during the period in which we wanted to borrow so much from the rest of the world, the mercantilist policies in China and in Asia generally have been willing to finance that, so we've been able to do it at very low interest rates, and we don't know how long that's going to last, and that will be a problem for the future. Let me stop there and take some of your questions.